Hey guys, Dan Bradbury here, and today I'm joined by Carl Allen, world-class entrepreneur, investor, and corporate deal maker. 30 years of experience, even though you wouldn't think it to look at him because he barely looks older than 18. Carl's been involved in more than 330 acquisitions with a total of more than 48 billion in 17 different countries from his career in corporate M&A. But now, since retiring from the corporate world, he focuses on helping entrepreneurs buy and scale businesses without risking their own capital. He's an absolute authority. I've known him for a long time. He's written a great book called The Creative Dealmaker, a fable on creative business buying that's well worth checking out. And he's a lot of fun. But the reason why I wanted to bring him on today specifically is Carl and I will probably end up talking about books because we're both book geeks and we speak about and share book ideas often. But because he is a partner in a private equity fund with hundreds of billions in capital, and he buys businesses. And that's what he does. He buys businesses. I want him to bring on from the perspective of what a buyer's looking for. Because when it comes to selling your company, I think people make it mythical, or some people go, people don't have the money, or how do you structure this and what's attractive? So he's got a unique perspective, and he's done this thing for a long time at a lot of scale. So that said, Carl Allen, welcome, sir.
Thank you. Great to be with you again.
You sounded very impressive there. I hope you...
I know. I'm like, who's he talking about? But yeah, it's interesting. So yeah, I'm 33 years in now, believe it or not, to my M&A journey. I started in 92. I've done about half of my time as a corporate guy. So I worked for a Wall Street investment bank. My last real job, if you can call it that, was part of the M&A team at Hewlett-Packard. So I did a $25 billion roll-up in IT services and software, retired in 08, and decided to do my own deals. I've bought over 100 companies personally in the last 17, 18 years. And now I'm doing what I call big boy pants deals. So I'm doing roll-ups. So I'm not a private equity investor that will go and buy a $50 million company. I'd rather go and buy 10, $5 million companies in the same industry and kind of knit them all together. I probably spend about 3/4 of my time in my PE fund doing deals in healthcare, financial services, oil and gas, also crypto. And then the other 25% of my time, I coach, right? And I'm teaching those people how to go out and how to buy companies. Some of them are individuals that want to leave a job, want to own a business, and rather than start one, which is a lot harder, go buy one. So I share them how to create very creative deal structures, what to look for when buying a business. So you're buying a business that's kind of a good fit for you and has got a lot going on and can be improved. I also help small business owners grow by acquisition. So if you own a $2 million business or £2 million business, rather than continuing to organically grow, how you can buy another company and make it even larger. And then we focus on other different ways that you can scale a company, you can create more value, you can make the multiple that you're looking to sell for higher. And then obviously it's all about the exit. It's finding the right type of buyer for you as an owner.
So let me ask a question, Carl. So there's three categories of people that I think are listening to this. There are some people that are listening because they are weighing up selling. Look, we all know that, the baby boomer generation and even Gen X now kind of retirement age, and they've got a lot of wealth tied up in their businesses, right? It's often worth significantly more than their property. So their wealth is tied up in their company and they're looking to sell that on. So a lot of opportunities for buyers. So the first category is they're looking to sell and they want to get maximum value. So that's one group of people that are listening. The second group are people that are going, look, growth through acquisition, because the real cost of assets has increased exponentially. Exponentially is a bit of a exaggeration, dramatically in our lifetime. And therefore, some people are going, look, why start a company if I can get rid of a lot of the headaches and I can buy assets, especially if I can buy them undervalued? So that's the flip side of the coin. But the third category, Carl, which I might be inclined to start with, are the ones who are listening to this podcast because they're regular listeners, but going to go, I'm not really interested in buying or selling. So let's kind of pique their interest first. And so what I'll say, Carl, and then I'll leave you to steer where you'd like to take it, is when I look back in my entrepreneurial journey and I look at any times of the most rapid growth, it's always, without exception, been preceded either by an acquisition or a strategic partnership.
Yeah.
And often those strategic partnerships end up in an acquisition or a
Yeah.
merger or something similar. So I think if you're listening to this right now and you're going to go, I'm not interested in exiting yet for a few years, I still think there's value for you here. And if you've never considered buying another company, I still think especially with the market as it is right now, you want to pay attention because there are going to be tremendous opportunities. And you've obviously, Carl, I like you for this interview because obviously you're a Brit. You've done a lot of deals and your career originally was in the UK, internationally, of course, but primarily you were based in the UK. And now obviously you've emigrated and you're now in the mighty Austin, which is a town that I've been to many dozens of times over the decades. Good God, Carl. In fact, it's funny. The listeners should know I first met Carl in a tiny, tiny upstairs meeting room, boardroom of a little cafe or something where there was only about 6 or 7 of us in the room. And at that time, bear in mind, Carl's got over 40,000 students now. At the time, Carl's students were barely into double digits. So we've come a long way, or we're very old, or probably a bit of both. Yeah, we've been around for a while, Carl. So with all that said, let me frame the question better in that your job now, your primary focus is deploying these funds. So you've got a significant amount of capital under management and you're looking for companies to acquire. So I want to make the argument that everybody listening to this, even if they're not looking to sell the company soon, should be to maximize the value of their companies so they've got the option to exit. So the question, Carl, is when you're looking a company to acquire, what are the big things? What's the first thing that you evaluate? How do you define a good business from a buyer's perspective?
Yeah, sure. So clearly, if you look at my buy box, right? So it all starts with my particular buy box. Is I won't buy any business under $1 million of EBITDA, right, or £1 million of EBITDA.
And for those that are not familiar with terms, we won't break into EBITDA, but basically profit before tax.
Yeah. So for me, I'm looking at your book, right? Turnover is vanity, profit is sanity, right? I'm not interested in the turnover. For me, it's the profitability of the business, because the more profitable the business is, the easier it is for me to finance that acquisition, right? So I'm a private equity fund, right? So I've got equity from my limited partner investors. When I buy a company, I'm not using all that money to buy the business, right? Like you would buy a house, I'm putting in some equity and then I'm leveraging up that equity. I probably put 25% of the purchase price down in cash from my fund, and then I'm gearing that up with debt from banks, credit funds, other financial services companies. So I'm interested in the profitability, because the profitability, the more profit it's got, the more I can borrow to put into that acquisition, to fund it, right? So first thing is got to be $1 million or above in profit, whether it's EBITDA, net operating income, pre-tax profit, whatever you want to call it. Then there's certain industries that I'm interested in buying in. So it could be e-com, it could be oil and gas, it could be financial services, it could be healthcare, right? Those are my key areas to invest in. And then beyond that, what I'm looking for is I'm looking for businesses that have got what I call moats, right? So I'm looking for businesses that have something about it that makes it unique. And every single business I've ever looked at, I've probably looked at 100,000 companies in my 33, 34 years of doing this. It always has one thing that it does incredibly well. I call that a moat, right? Or you could call it a superpower. And then what I'm looking to do is take a business like that, match it with another business in my portfolio that's got a different moat, and then I'm going to cross-pollinate those superpowers across all my other different businesses, right? There are a lot of other things that I look for, right? I don't like businesses that are what I call owner dependent, right? So imagine you've got two companies side by side, right? Let's say I own a business and you own a business. They're identical. They do the same thing. They're in the same town. They got the same customer base, right? But I'm in the business 60 hours a week. There's no KPIs. There's no systems. It's all in my head. All my relationships are personal to me. And I'm doing the vast majority of the needle moving work in that business. Whereas you own the same company, you're in it 5 hours a week. You're working on the business, not in the business. I'm working in my business tactically, not really on it strategically. And for that reason, your business is worth a lot more money than my business, right? When I sell my business, it's going to generally be on an earn-out structure, which means that I'm only going to get paid over time if the business continues to perform, and I'm still going to have to do all that work, right? Because the business is not going to function properly without me, right? If I sell my business to somebody and then I go and retire, it's like buying a TV with no instruction manual or no remote control. Don't know how to operate it, right? It's not going to work. Whereas your business, it's like a machine, right? It's like a machine. There's like an instructions manual with it. You have a team that runs that business for you, and it works whether you're in it or you're not, right? So I'm looking to buy businesses like your business, not like my business. Because if I buy my business and the seller leaves and exits, I don't know what to do with it, right? It's going to take me a whole bunch of time to kind of figure it out. And so that's one of the key things that I'm looking for. The second one would be customer concentration. I don't like businesses that have very, very high customer concentration, because if that customer was to leave and go and do business with somebody else, a ton of my revenue and profit is going to disappear. So I don't want any company, any customer to be more than, say, 10% of the total revenue. And I don't just do revenue by customer analysis. I also do profitability by customer analysis, because you could have 10 customers in a company all contribute 10%, but if one of those customers has a disproportionately higher chunk of my profit, I want to know that, because the business might be sensitive to that customer leaving. I like recurring revenue. I like businesses that have a very low customer churn. I don't like businesses that are lumpy in terms of their revenue. I like nice, predictable, boring, recurring revenue streams. And I also like businesses that have got long time tenured employees, right? I don't like businesses where it's really hard to hire new employees to grow. And once I hire them, it's very expensive to kind of keep them, right?
The late, great Charlie Munger, who's down there, poor Charlie's Almanac, not Charlie Munger's Ashes, his book is down there.
But
It would call it inversion, right? So what Carl was saying about the things that you like, those of you listening, you could just say it's about mitigating the risk. What are the risks and how can you mitigate those risks? Concentration risk from one customer being too big a percentage, key man risk, the business being too dependent upon you. But in fact, as an aside, you also mentioned synergies, saying a company that's strong, company's weak. My first ever deal, Carl, which I don't think I've ever mentioned on the podcast before. Interestingly, I had a business where the sector's kind of irrelevant. The point was I was really good at the back end about monetizing customers and maintaining long-term relationships and a lot of revenue, but I was rubbish at lead gen. I was hopeless, completely hopeless. And I got lucky in that somebody approached me who had a good business, and it was the opposite of me. They were really bad at the back end, but they were really good at the front end of the lead gen. And they basically said, look, you need to come and buy my company. And I said, well, I don't have the money. And they said, well, and it's funny because these deals aren't common. I want to be clear, necessarily that common, but this did happen. He went, look, the business is worth a 3 times multiple. I made 200 grand last year. Give me 600 grand. I went, I don't have 600 grand. And he went, do you have 30 grand? And I went, yes. And he went, okay, put that down and then pay me the
rest over time.
Correct. Yeah. Over 3 years. And he goes, but then I can then step out. And the reason why it worked perfectly is not because the business I bought was that great, but because I was able to cross-pollinate with my existing company, and it caused my existing company to double the next year and double again the year after because of the database. And so that's where some of you listening now think that whatever your business's problem is like that's just a difficult problem to solve. And it is for you.
But not for somebody else.
Yeah, right. Somebody else finds that a piece of cake. And so while we could go down risk mitigation, the route I want to take us down, Carl, is I'm going to stay inside of deals for the moment and talk about valuation versus terms. Let me ask you something. What would it feel like to wake up tomorrow and know that you've secured the perfect buyer for your business and millions are about to hit your bank account? In the last 5 months, I've helped 6 business owners do exactly like that. 5 legitimate offers between 1.5 and 6 million pounds. One's already complete, the money's in the bank. One's deep in due diligence, and 3 we turn down. Why? Because we know they can do better. It's not about luck, it's about strategy. I know how to prepare your business for an exit. I know how to attract the right buyers, and I know how to negotiate so you walk away with the best price and the best terms. On the 16th and 17th of September at my Scale and Exit Masterclass, I'm going to hand you the same roadmap that's creating life-changing exits for my clients. If you've ever dreamed about selling or even just scaling with freedom in mind, this is your moment. Don't wait, the time is now. We know it well and the listeners may not. You set the price and I'll set the terms. So what does that mean? As in when they're talking about terms, some people that have never bought or sold a company before might be expecting, especially in the SME market, yeah, great, I'm going to sell my company. I'm going to sell it for £1 million and you're going to give me £1 million cash at closing and that's it. And the deal's done. And yet that's rare that's the case. So can you speak to terms and how a deal typically structured? That's
Nobody's ever going to pay 100% of the purchase price at closing, right? They're always going to hold something back, whether it's, for 90 days for a handover or whether there's some contingent things that have got to happen in the future. But to your point, right, there's only two variables in any negotiation when you're buying or selling business, right? And you've nailed it, right? It's price and terms. And what you tend to see is only about 1 in 10 deals that actually try and close succeed, right? The other 9 out of 10 that fail, one of the big reasons for that is a buyer or a seller want to control both the price and the terms in any negotiation, right? So what you have to do as a buyer or a seller is almost pick the side that you want, right? So, and it depends on the seller and it depends on the buyer, right? So some buyers, if they've got a lot of cash, or they've got access to a lot of capital, would rather pay a lower valuation, but put most of the capital into the deal at closing versus paying a higher valuation, but having terms on that deal structure. And it's exactly the same when you buy a car, right? So I bought a couple of cars since I moved to the US, right? When one of the cars I went and I paid cash for it, right? So I paid cash for my 911 and I obviously got it at the retail value. Whereas my son's Tesla, they're 17 now, he's learning to drive past his test. I leased his car. So I'm going to pay a lot more for that Tesla over the 5-year lease because of obviously the interest and the financing of those payments, right? It's exactly the same when you sell a business. Your valuation really is irrelevant. Is the deal fundable, right? So on average, a business doing £500,000 to £1 million a year in profit, let's say on average it's worth a 4 times multiple, right? There are a lot of other things that can change that number, but let's say you're worth a 4 times multiple. If you want a 6 times multiple for that business, right? Unless you're absolutely best in class, unless you're the best business in the market for what you do, you're not going to get all that cash at close. You might have to wait 2, 3, 5, even 10 years to get the rest of those payments, like you would if you were selling a car on terms. Versus if you want all of that cash up front, or most of it up front, you're going to have to take a discount on that value because successful deals that close down, it's where buyer and seller are effectively co-owning the risk of that transaction, right? So if you will, the tipping point is if you're buying or selling a company, if you put half down at closing and then you finance the rest over time, you could argue that the risk of that deal is shared, right? If the seller's getting all the cash up front, the buyer's taking all the risk, or the bank. If the seller's getting nothing at close, but they're getting all of their payments over time, then the seller's taking all the risk. So for that reason, the seller's going to want a much higher valuation to want to do that deal. And it sounds crazy that somebody would own a business for 20 years, build it up to be something successful, and then would sell it over a 10-year period, right? It sounds crazy. We call that an annuity deal structure. And it's a lot more common than you would think, right? So if you can imagine that you're a 60-year-old business owner, you've been in your business for 20 years, you decide it's time to sell, right? If you sell it over a long period of time, number one, that deal can happen in a matter of days, right? The buyer's not going to do a ton of due diligence if they're not taking any risk and they're not raising any capital. So it's a super quick deal for the seller. They don't get brain damage from having to go through all the due diligence requests. They're going to get a lot more money for their business. And then it's also very, very tax efficient. So a long time ago in the UK, and it was the same in the US where I live now, if you did a creative deal, a seller financing deal or a deferred payment deal, the tax authorities would charge you the tax on the entire deal and you would have to pay it all up front, right? But then both the HMRC and the IRS in America created this installment sale structure, whereas as long as the deal is cash flowing over at least 2 tax periods, right? The tax authorities would only charge you the tax on the years that you make the payments, right? So let's say you had £1 million business, that's the value, and you were selling it and you were getting most of that money up front. You're going to pay a lot of tax up front on that exit, right? And then you've got less left at the end of the day after you've paid your tax to invest to live the rest of your life. Whereas rather than sell for £1 million, if you sold for £2 million, but you were paid over 10 years, so it's £200,000 a year, you're going to pay a lot less tax in those years. And then, you know what's really interesting, Dan? When a lot of people sell, especially retirees, they don't necessarily want the big capital gain. They just want the income. Mm-hmm. But they're getting the income every year and it's taxed as a capital gain, not as income. So it's a much lower tax rate than what they would if they were just pulling the money out the salary.
Yeah, it's interesting. I suppose related to that, let's talk about the psychology briefly. I know you often say deals are won or lost in the relationship with the seller and obviously presumably the buyer. So what do you mean by that?
Yeah, so a lot of times it's, you're a marketer like me deep down, right? So marketing's all about know, like, and trust. Like people buy products and services from people that they know, they like, and they trust, right? Businesses are bought and sold, especially in the lower echelons of the industry, from people that they know, like, and trust, right? And a lot of business owners that are looking to sell, they're looking for what I mentioned before, that safe, trusted pair of hands, right? So let's say you started a business 20, 25 years ago. You've busted your chops in that business for over 2 decades. You've missed family holiday, you've missed parents' evenings, you've missed all those different things, right? And you've got it to a stage now that you're looking to retire, you're looking to sell. You've made your money. You don't necessarily want to sell that company to just anybody because you care about your employees, you care about your customers, and you care about the legacy that you've built, right? You want to be able to drive down the street in 5 years and see that business that you built continuing to thrive. So a big part of the negotiation is to really understand what, as a seller, are they truly looking for out of that deal. And oftentimes it's not monetary. They just want somebody that's going to love, cherish that business, not change too much, be that trusted new owner of that company. And if you can convince them that you're that person, right? They want to see that you've got, chops in this market, you've got a lot of skills and a lot of value that you can bring to the table. And if you're that person, they're going to be a lot more creative and flexible with you because, they're going to want to do the deal with you versus somebody else that they think, well, they're just going to rip this apart, do a lot of damage, and they don't want their employees, to be put in harm's way. So that psychological piece is really, really important. And the first question I always ask a seller, right, before I get into the business model, the unit economics of how it works, how they scale, how they add new customers, the very first question I will ask a seller is, why do you want to sell?
Yes.
Why do you want to sell the business, right? And I'm looking for sellers that have got some motivation to want to exit. It could be retirement, it could be boredom, it could be they're stressed out, they may be getting divorced, not just in a husband and wife divorce, could be a shareholder divorce, right? It could be that they've just run out of ideas, or they feel they've taken the business as far as they can, and they don't want to have to raise more capital to scale. They don't want to buy another business to create more value. They don't want to do all those things. They've kind of reached the end of the line. So that's the first thing that I'm really looking to understand, because once I understand that, then all my different types of deal structure and all my different kind of ways of making offers, I can kind of navigate that, because there's so many different ways that you can put these deals together. Some businesses that I talk to that think they want to sell actually don't. They're just lonely. They just want a partner. They want somebody they can brainstorm with, somebody that they can kind of run ideas by. They want somebody to kind of kick the tires with, right? They actually don't just want to sell the business. They put their business up for sale. It's like a cry for help. It's like, I just want a partner. If you buy a little bit of my business, then let's run it together. Maybe you go off and do more deals for us. I'll just run the day to day. Let's quadruple the value and then we'll both sell it, right? So there's always lots of different ways that you can put these together. But it all starts with that, for me, number one killer question: why do you want to sell?
I'm going to do a lightning round, Carl. I've got 5 questions. Let's put, I don't know, a 15-second timer maximum on each of the 5. And anybody listening, if you want me to get Carl back on, well, please do that, because I want to get Carl back on. I want to tell him I've been lobbied by results. Right, ready for this, Carl? So, lightning round. Number 1, for entrepreneurs thinking of selling in the next 2 to 3 years, what's the one thing they should focus on today to maximize their company's value?
Get out of the day-to-day operations of your business. Work on your business, not in your business.
That's good. Number 2, what's one business book you think every entrepreneur should read but probably hasn't?
Your book.
Thank you. Either of them, both of them. I can get Carl's as well. Number 3, what's one skill you wish more entrepreneurs developed before trying to sell their company?
How to profitably acquire a new customer.
Oh, very good. All right. Number 4, what do you believe about buying businesses that most people would disagree with?
The psychology of the seller makes a massive difference on the price and terms of the deal.
I love it. And finally, if you had to start again with 0 money, what type of business would you buy first and why?
I would buy probably a plumbing company.
Oh,
because AI cannot plumb a toilet.
yes, that's a great answer. That's a great answer. And finally, Carl, we'll put links in the show notes. Where's the best place to hunt you out? YouTube, Instagram?
Yeah, at Carl Allen Official. Hit me up on Instagram, hit me up on YouTube. That's where I'm putting content out on there every single day. And then there's paths from that to get deeper with me in some of the things that I do. But then, yeah, go read my book.
Yeah, The Crazy Dealmaker.
It's a fable. Yeah, it's a story of a buyer and a seller that come together. And it talks about all this psychological stuff that most valuation books don't even touch on. But for me, that's everything. I think that's the one thing, Dan, in my business buying coaching career that I think's truly defined me. It's been able to read and measure seller psychology and how that translates into price and terms. It's the most important thing.
Love it. It's been a pleasure as always, my friend.